Hi, this is Albert No, Senior Portfolio Manager at Empire Life Investments, here with another segment of Off the Cuff. First, I just want to wish everyone well, and I hope that you're managing during these unusual times. Here at Empire Life Investments, we are trying to do our part to flatten the curve. The investment team is working from home or remotely, and although we're not in the office every day, things are going pretty smoothly. We're in constant communication and updating each other with ideas and what's going on in our respective markets and portfolio companies. With the first quarter past us, I thought I would take this time to provide a bit of an update on what we've been seeing in the corporate bond markets. The first quarter was the most volatile we've seen since the financial crisis. And although the magnitude of the sell off was not as extreme, the pace was roughly 2 times as fast. In a matter of a couple weeks, we saw corporate bond spreads go from historical lows to cyclical highs. And it was the type of market where there was really nowhere to hide other than government bonds, which did their job of acting as insurance. During the quarter, government bonds were up, while all the other asset classes we invest in were down. The investment grade corporates were down 3%, high yield bonds were down 13%, Canadian preferreds were down 25%, and equities were down around 35%, with the heaviest losses occurring within a 2 week time frame. Given the speed and the severity of the sell off, we've been asked if this is a repeat of the financial crisis. I do not believe it is, as we are not questioning the solvency or the functioning of the financial system. Instead, in Q1, we had two big external shocks in the COVID pandemic and the oil price war between Russia and Saudi Arabia. These events triggered a sell-off of which the speed and magnitude was exacerbated by one, the growth of fast money such as ETFs and algorithmic trading in credit markets, and two, the temporary lack of liquidity as many participants were rushing to raise cash at the same time. In a matter of weeks, the Fed and other central banks implemented various policies to shore up liquidity, and we've seen an improvement in the functioning of fixed income markets and the ability of companies to access credit. Since testing the lows in corporate bond markets, the market has recovered about 1/3 of those losses. So where does that leave us today? Going into the year, our corporate bond portfolios were positioned fairly conservatively, given that corporate bond spreads and yields were at historical lows. And from here, it's impossible to predict the direction of the market in the short term, but our process remains the same, which is to invest in companies that have sustainable balance sheets or that provide attractive risk reward at attractive valuations. And so as spreads have gone from historical lows to cyclical highs, we are seeing many attractive entry points to invest in good businesses with strong management teams and balance sheets at valuations we haven't seen since the financial crisis. These types of opportunities don't come along all the time, but you can rest assured that we are in a good position to take advantage of them as they arise. Thank you.